Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance. Sometimes these filings are so dense you need a decoder ring to figure out what is really going on. And today's decoder ring is for Generation Income Properties Incorporated. Get ready for a whirlwind tour of their latest financial report because we're diving deep into the numbers and uncovering a story that is a little more complex than just straightforward growth. If you are into getting the real scoop behind company reports, smash that subscribe button. And hey, we've got a growing community on Discord, link in the description below, where we break down these filings even further. Alright, let's jump straight into the heart of this report, the financial tables. First up, the balance sheet as of the 30th of September 2025, the company's total assets stand at around $103 million. That is down a bit from about $106 million at the end of the previous year. Now, where is that change coming from? A big chunk of it is in their investments in real estate, which saw a decrease, and also in cash and cash equivalents, which dropped pretty significantly from over $600,000 to just about $247,000. Looking at liabilities, total liabilities are pretty much right where they were at the end of last year, hovering around $73.7 million to $74.5 million. But here is an interesting observation. Their accounts payable almost quadrupled from roughly $171,000 to over $611,000 in just 9 months. That could mean they're juggling bills a bit more. Or it could just be timing. Now let's talk about equity. This part is a bit more concerning. Their stockholders' equity has swung hard from a positive $5.7 million at the end of last year to a negative $3.9 million at the end of September 2025. This means they have an accumulated deficit, which basically means they've lost more money than they've made over time. This is a pretty significant shift and definitely something to keep an eye on. Moving over to the income statement for the 3 months ending the 30th of September 2025, the company reported a net loss of about $1.7 million. For the same period last year, the loss was around $2.1 million. So a slight improvement there, which is good. But looking at the 9-month period, the loss actually widened from about $5.4 million last year to nearly $7 million this year. So while the short-term picture looks a little better, the longer 9-month trend shows them losing more ground. And even though they're reporting these losses, there is still a portion of income that is not theirs. They've got net income attributable to non-controlling interests, which was over $1 million for the 3 months and almost $3 million for the 9 months in 2025. This shows that other people have ownership stakes in some of their properties, and those stakes are earning money, even as the main company struggles. Let's look at the cash flow statement. For the 9 months ending September 2025, their operating activities generated about $415,000. That is down from over $783,000 in the same period last year. While they are generating some positive cash from operations, it is a shrinking amount, which could be a red flag for future operational funding. On the investing side, this year they brought in over $10 million from selling assets, which is a positive inflow. Last year, they used over $5.9 million for investments, so this year's sales provided a significant boost to their cash situation. Financing activities saw a big outflow of over $11 million used in the 9 months ending September 2025, compared to a positive inflow of about $3.6 million last year. This large outflow is likely due to debt repayments and other financial maneuvers to manage their capital structure. In terms of what this company actually does, Generation Income Properties is a real estate investment company. They focus on buying and managing properties that generate income, like retail, office, and industrial buildings. All across the United States, they've elected to be taxed as a REIT, which is a real estate investment trust, meaning they have to distribute most of their taxable income to shareholders. Now, this next part is pretty important. Under accounting rules, companies have to talk about their ability to keep operating if things get tough. And Generation Income Properties is flagging that there is substantial doubt about their ability to continue as a going concern for the next year. This is a big deal. They mention that their ability to keep going depends on executing management's plan to improve their financial situation. They're talking about refinancing, extending loan terms, and strategically selling off properties that aren't performing well or where they see a good opportunity to sell. When we look at their leases, they break down rental income into fixed and variable. For the 9 months ending September 2025, fixed income was about $6.6 million and variable was about $752,000. They've also got a few major tenants like the General Services Administration and Dollar General. For instance, the General Services Administration properties are bringing in about 16% of their rental income. The company has a lot of mortgage loans and it is important to track these. As of the 30th of September 2025, they had over $55 million in mortgage loans outstanding. They list out each loan with details on the tenant, location, interest rate, and maturity date. For example, they have a loan for the 7. Eleven property in Washington, D.C. that matures in early 2026. Many of these loans have debt service coverage ratio requirements, which is a measure of how much operating income a property generates compared to its debt obligations. It is basically a way to see if the property's income is enough to cover its loan payments. Here is a crucial risk factor. The company has received a notice from NASDAQ because they aren't meeting the minimum stockholders' equity requirement. They've got a deficit in stockholders' equity, which means their liabilities are greater than their assets from an equity perspective. They've submitted a plan to regain compliance, but if they don't, their stock could be delisted from the NASDAQ capital market, which would be bad news for investors. So, what is the big picture here? Generation Income Properties is navigating a challenging financial environment. They're seeing some revenue growth, but their losses are substantial and growing over a longer period. The shift to a negative equity position is a significant concern, and the threat of delisting from NASDAQ adds another layer of risk. They are actively trying to manage their debt and portfolio, selling some assets and refinancing others. However, the going concern warning suggests a tight liquidity situation. It seems like they're in a phase where they're trying to fix their financial structure by selling off properties and managing their debt, which is a common strategy for companies in this situation. The question is, can they successfully pull off this turnaround before the financial pressures become too much to handle? Especially with that NASDAQ delisting threat looming. Alright, that is our breakdown of Generation Income Properties' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.